years, people were primarily looking at fixed interest rates, but now I'm hearing a lot about ARMs. Can you tell us what's the difference between those two?
Sure. So you've got your fixed, and then you have your ARMs, which are also called adjustable interest rates. Okay. So with a fixed, it's just like what it says. That interest rate is going to be fixed for that entire term that you got the loan, whether it's a 30-year, 20-year, 15 years, however many years that you're spreading that mortgage over, the interest rate is going to be fixed for that entire term. When you get on an ARM or an adjustable, you have many options there, 3 years, 5 years, 7 years, 10 years. And what that means is that interest rate is going to be fixed for that period of time. The payment is still spread out, typically over 30 years. So it's amortized over 30 years. But the interest rate is only going to be fixed for that period of time.
I see. So it sounds like both of these, there's a list of pros and cons for each.
Yeah, so typically the interest rates on the ARM or the adjustable will be a little bit lower. It's not always guaranteed that way, which is why we haven't seen many people take ARMs. But lately, the short-term rates is what we call them as well. The rates have been pretty significantly lower. So what this may do is help maybe some of our younger people coming into the workforce who want to qualify for a little bit more. The adjustable may be a good option for them. Give them a 5-year, ARM. The rate's fixed for 5 years. After that 5 years, they're going to be up in the company and making more money. So we can refinance them and get them on a fixed.
That makes sense.
Yep. Or some of our people that are on fixed incomes as well, or older generation, they may need that fixed payment, but low enough for them, and they plan on paying off the home in a number of years. So 5, 7 years, and we'll look to get them on that 5 or 7 years to keep the payment down, and then they can pay extra towards the principal. So there's a lot of different reasons why we would look at both the ARM and the fixed for somebody.
So when someone first talks with you, you go over different types of mortgage, but you also look into whether or not a fixed or adjustable rate would be good based on what their goals and objectives are.
Exactly. Long-term goals, short-term goals, what they anticipate to have with their income. Maybe the spouse, they just had a child, she's not working, but she'll be back in the workforce in 5 to 7 years. Then maybe the adjustable is going to help them get through that period of time. And then when she's back in the workforce, we can refinance them. So yeah, there's a lot of different factors me and the client are going to look at and discuss to find out what's going to be more beneficial for them.
That makes sense. Thank you for doing that for us.
Sure, yeah.
Thank you.